All right, it's 7:02, and I appreciate your promptness. So we're going to go ahead and dive right in. Just please be patient with me as I let folks in from the waiting room, and my attention may have to go over here every once in a while. But once again, welcome to Wine and Real Estate. I appreciate you guys joining me this Friday evening, and I'm kind of excited for this week because this week is because of you guys. You chose the topic. So we're going to spend this week, definitely next week, and possibly a third week, more than likely, because the topic of owning income property covers so much that there's no way to get it all into one conversation. So we'll go ahead and get started. Those of you who have been here before already know the rules. The rules are there is no silly question. Essentially these sessions are for you guys to get any questions answered that you might have about owning real estate, owning income property, getting started as an investor. You know, I've been there. I've been full-time in real estate since 2003, started out as an investor, moving into other avenues, brokerage, construction, development, etc. So I'm happy to answer any questions related to those topics. And I promise you, I do not have all the answers, but whatever answers I don't have, I am happy to point you to a resource that can help with the answer for those. So no such thing as a silly question, so ask away in the chat room, and later on we can open up microphones so that everyone can chat too. Hey, Christina. And then also to test out the chat rooms, if you guys would just post a note as to where you're calling in from. I always like to sort of understand where you guys are, because if there are any resources in your areas, I know we've had a couple times when folks were calling in from Minnesota and some Atlanta and some Chicago. So if there are specific resources in those areas or speakers that I can get on the call, I want to know where you guys are at. Oh, yay. All right.
I don't see on here, where do you type that?
There is a chat room. It's at the bottom of my screen because I'm on my.
Oh, I see it. Thank you. Thank you.
Chat. You got it?
Yep.
Okay. All right. My eyes are darting all over the place. So once again, I am not a CPA, attorney, lender, other real estate professional. Building your team is one of the most important parts of being successful in real estate investment because you can't do it all yourself. Even if you want to buy a home, and I see some of my fellow realtor colleagues on here like Marvin, and I'm sure some others will join. I have to look through the list. Building your team is going to be a really important part of the process. So keep in mind as well, real estate involves risk. So anytime you're going to step into any type of real estate investment, even if it seems safe, you need to make sure to cover your due diligence and have team members, especially if you're new at it, be there to sort of look over your shoulder and help to make sure that you avoid some of the pitfalls that come with the risk reward balance of real estate investing. Let's see. So today we are going to cover the topic that you guys mentioned at the last session, which is owning income property. And today I see a good friend of mine, Aaron Lubeck, on the call, who gave me a really good book a few weeks ago called Start with the Why. And that is the inspiration for today's session, which is, what is the why? Why do you want to own real estate? Because essentially owning real estate, I'm gonna make sure I mute everyone. Owning real estate involves risk, and knowing what your why is what's going to keep you in the game when stuff gets hard. That's what's going to, sort of keep you in there, and understanding your why is going to help you decide if real estate investing is for you. So the why that we're going to cover today are the sort of pulling back the mask of income property and the numbers that you're used to seeing on the surface. Some of you who have attended the in-person wine and real estate sessions here in the Triangle have seen this example that I'm going to start with today. It's always good to see it again to make sure it's solidified for you. And feel free to ask any additional questions. I just want to make sure that everyone leaves this call sort of on a level playing field, so that when we move to the next topics, you can sort of bring what we're covering today over to future conversations. Grab your cups, glasses, mason jars, whatever you're drinking from, and let's say cheers. Everyone, this is After All Wine and Real Estate. This is tea for the first time ever at Wine and Real Estate. So what's the date? I need to mark this as a point in history, but this is hibiscus tea. But cheers to everyone. Thank you so much for attending. I hope that this is beneficial and that you leave with at least one nugget and one point of inspiration that will help to advance your real estate investing goals. Salud. Give me 1 second. Okay. I might have a little bit of scattered attention down the line as I keep letting folks in, but there are 40 of the 60 something here, so I think it should be slowing down now. So I wanted to sort of start with the reason why I believe, and this is personal, why I believe not only, you know, owning a home, but why owning real estate, income real estate is so important. You know, I think everyone right now in the midst of everything that's going on, you know, has a clear picture that, you know, housing and housing security and financial security is very important. Real estate is one of those mechanisms that can help to create that financial security for you. Real estate also comes with responsibility. Again, with that reward comes risk. So it does have to balance out, and you do have to figure out if it's going to be for you. For me, real estate has been life-changing, and you know, it has provided a level of freedom that I'm pretty certain that I would not have had even in my former life as a software engineer. And that freedom in part was created by real estate growth and portfolio growth and equity growth. And so we're going to talk about that today and sort of the opportunities that that creates for you over the long term. Let's see. Second point, I know everyone is going to have a lot of questions about a lot of different facets of real estate and a lot of different areas. One of those being property management and tenants and handling repairs and all that fun stuff that goes with holding properties long term. So if you could hold those till the next session, I'm really excited that one of my favorite property managers in the area is going to be joining us in the next session. The entire next session is going to be about property management, how to manage your properties effectively, how to select tenants, how to manage your tenants, how to manage your manager if you choose not to self-manage your properties, and also handling repairs and other maintenance things. That's the entire conversation next time. So I'm excited to cover that. So know that that's coming up soon. And we will dive right in. So when I started in real estate and I first, you know, became more aware of rental property and landlording and income property, my first assumption was that, hey, if you buy a property and the mortgage is $10 a month and you have a tenant who can pay you $12 a month, then you're making $2 a month on that property, which is true. But that was the extent of my understanding of what owning income property was the monthly cash flow. So how many of you sort of feel the same way that I did at the start in thinking that cash flow maybe was the only benefit to owning income property? You know, maybe in the back of your head, you thought that there might be other things that came into play too, but primarily the cash flow. Thanks, Paul. Hey, Paul's back. Thank you guys. Tracy, Tavona, awesome. So yeah, I mean, that's really all that we hear about. And it's kind of like I realized as I dug more into it that people were kind of keeping secrets, because there are a lot more areas of benefit for owning income property. And I'm going to step out the frame because what's going on this board is much more interesting than looking at me this evening. So horrible artist Tiffany, that's an iceberg, believe it or not. And that's the water line, believe it or not. So this is where cash flow goes in that formula of thinking about what the benefits are. Yes, CF is for cash flow, sorry. That's where, that's what everyone is thinking of. But if you think of it as an iceberg, that's just the tip of the iceberg. If you look at this proportionately, so much more of the benefit happens down here in real estate investing. And this is what we're going to talk about today, because what I pray from this conversation is that everyone leaves here sort of having a eureka moment, like, okay, now I get it. Now I understand why certain people are out there buying properties and building a portfolio and taking on all this risk. It'll hopefully become much more clear. Second thing is, everything that I'm about to put on the board, you do not have to write any of it down. It is already on my website. If you go to tiffanyelder.com, on the left side, under investor resources, there is a link to a page called financial benefits. And it walks through, it's the exact same example I'm gonna walk through here. For you guys, we're just gonna break it down and sort of talk about it and what everything means. So don't feel like you have to write anything down. So to start, we're just gonna use a simple example. So some of these numbers, when I wrote this example, and this is now that I'm thinking of it, when I wrote this example, these numbers were pretty close to what was available and what was realistic for my market here in Raleigh, Durham, Chapel Hill, North Carolina. Because the market has grown so much, finding an example like this is much more difficult. So maybe I need to go out there and put another example with some higher price points on it. But again, that goes to show that real estate grows in value and that it calls into play the fact that owning it can create benefit for you over the long term. So to start, we're gonna cover some assumptions. Can everyone see this clearly? Can I get like some yeses and, okay, yay. And if I'm writing too small, put in the chat box, Tiffany, write bigger. I'm gonna be erasing all this as we go through it. But again, this entire example is online. There is one numerical mistake in there, I think it's a $10 mistake that I'm gonna edit, but everything else that you'll see online is exactly what you'll see here. So let's say that you decide that you want to buy an income property, and you, right now, let's say your annual gross income is $50,000. Y'all see that? Yeah, maybe. Okay, your income's $50,000. Let's say your federal tax rate is 25%. Let's say your state tax rate is 10%. Those are your tax rates. And let's say you decide to buy a modest $100,000 rental property. So in our market here in Raleigh, Durham, there may still be some $100,000 properties available. 9 times out of 10, they're gonna need a whole lot of work. They're not gonna be in the best condition. Back then, you could buy a $100,000 property that might be sort of move-in ready, but still, for the sake of the example, we'll walk through this because some of you guys in your markets, these numbers may still ring true today. So let's say you're gonna buy a modest $100,000 property, and it's a single family home. And of that $100,000, 90,000 of it is the land value. Is the house value. Yeah, let's try a tissue. 90,000 of it is the house value, the structure on the land, and 10,000 of it is the land value. Because of course, when you buy a piece of property, you're buying the structure itself, you're also buying the piece of land that it sits on. So let's say that's the breakout for this property. Let's say you go to a bank and you decide that you're gonna finance it with a mortgage, and you can get a mortgage for $550 a month, principal and interest. So your mortgage payment is split into principal, interest, tax, and insurance. We'll talk about tax and insurance in a bit. But $550 is principal and interest. $450 of that is the interest. These numbers will come into play later, and which leaves about 100 of that toward the start of the mortgage is your principal that you're paying off with every payment. Oops. All right. Let's say your property taxes are $600 a year. Let's say your homeowner's insurance is $300 a year, which is actually low. But I must have had a client who was able to get a $300 a year policy back then. And let's say you can rent the home for $950 a month, which is your rent. And there are a lot of folks who want to have income property, but they don't necessarily want to have to manage everything that goes along with owning income property. So let's say you pay a property manager $75 a month to manage the property for you. I'm not going to write it here, but just keep $75 a month for property management in mind. So we're going to sort of dive into this example. Your goal with this property is to hold it for 5 years and take a look at your portfolio at 5 years and see how the property has performed after 5 years. So do all y'all agree that these numbers are pretty simple, reasonable income property assumptions that kind of represent the everyday property, the everyday person? So this property is about to make this everyday person a lot of money. Let's talk about appreciation because we're going to get to that later. And I don't want to stop walking through the example. So everyone is familiar with what appreciation is in general. It's, you know, the value that your property gains over time as property values go up. Depreciation is property values going down. So over time, real estate, if you look at the last 50 years in the market and were to sort of level out that line, because real estate kind of goes like this. It has moments where it's, you know, increasing quicker, then it might flatten out. Some markets, it might slow down, it'll increase again. But if you were to normalize that line and flatten it out to a smooth, straight growth line, real estate over the last 50 years has increased across the United States as a broad average 5% a year for the last 50 years. Would everyone agree that sort of a test or a history of 50 years is pretty safe to assume what the future growth of real estate may be, barring anything unforeseen happening over the upcoming decades? Would you kind of agree that 5% is a safe number to assume? Great. So for our example, we're not even going to assume 5%, and I'm still going to show you the money that this property makes, but I want you to keep in mind that, you know, everyone needs a place to live. I say that all the time. You know, when it comes down to the general priority of needs, you know, there's shelter, there's food, there's, you know, safety, companionship, you know, whatever the ranking is for those things. But everyone on this line who has the privilege of being able to get on the internet and get in on, you know, any webinar or get online absolutely has a roof over their head. And that roof over your head is your main priority. And the roof over your head is what creates that benefit for you, because the people who own those roofs are the ones who benefit from appreciation over time. The market can fluctuate. We saw in the last recession that, you know, it can dip. Fortunately, in our market here in the Triangle, we flattened out and we had a little bit of a slight dip. I know a lot of us heard about California going up and then, you know, dropping off, or New York dropping off, or some of the more aggressive markets. But again, over the last 50 years, that's a really good test example to let you know how real estate performs over time. And real estate over that same 50 years has performed better when annualized than the stock market or any other investment. Real estate, again, has created more millionaires in the United States than any other industry. And it's an industry that the everyday person can step into and be a part of. It's just a matter of making sure that you step in responsibly. And I would recommend having a long-term vision. Don't step in with a get-rich-quick sort of mentality. So keep in mind that 5% appreciation. And I'm going to get back on this board. So you have the property. Let me scoot this back up. So you own the property and you decide to rent it out. So your first benefit for this property is cash flow. I abbreviate everything. So CF is cash flow. Your cash flow on this property is the difference between the rents you receive minus the mortgage and other expenses you pay out. So on this property, your cash flow is the $950 a month you receive in rent minus the $550 for your principal and interest on your mortgage that we walked through just a bit ago. Hang on a second. Minus $50 a month, which is your property taxes, because your property taxes were $600 a year, which equates to $50 a month. So that's your property taxes, minus your insurance of $25 a month, because we said the insurance bill was going to be $300 for the year, minus you decided to hire a property manager to manage the property for you so that you didn't have to deal with all the interactions with the tenant. You don't have to screen the tenant. You don't have to show the property to put the tenant in place and all that fun stuff. So once you subtract out all of these items, you're left with $250 a month in cash flow, which is $3,000 a year. So I'm trying to get some head nods here again. Would everyone agree that buying a property and hanging on to it and getting cash flow and benefits and giving yourself essentially a $3,000 raise every year is pretty good, like is a pretty good deal? It gets better. So on top of cash flow, this is the tip of the iceberg that I was just mentioning to you guys. Below the waterline is what we're about to dive into now. So aside from that, there are some other benefits. Now, these change with tax law, but at the time of this example, I'm just going to walk through the numbers that existed then, sort of summarized. So you have interest and depreciation deductions. So these are tax benefits that belong to individuals who own property, but some of them are specific to individuals who own income property. So rental property owners can write off the amount of interest that they pay on their loans, unless there are certain situations about their tax and income situation that disallows that. So talk to your tax professional. But the IRS also kind of requires that real estate investors depreciate their investment properties. Now, depreciation is what we call a paper loss that is required to sort of account for the estimated wear and tear of a property. So that $10,000, remember the property is worth $100,000, $90,000 is the building sitting on the land and $10,000 is the land. The land ain't going nowhere. So you can't depreciate the land, but that $90,000 structure that's sitting on the land, of course, it's not going to last forever. Uncle Sam understands that. So if your tax situation allows, you can depreciate that structure that's sitting on the land. There are a couple ways to do that. For the sake of this example, we'll use what's called straight line depreciation. I'm not a CPA, check with your CPA or tax advisor. But straight line depreciation allows you to depreciate over 27 and a half years. So what you do is take that $90,000 value of the actual structure sitting on the property, divide it by 27 and a half years, and that allows you every year to write off an additional $32.72. I know my handwriting is horrible here and I'm writing on an angle because I'm kind of off to the side, but just work with me. That allows you to write off an additional $32.72 a year off your taxes. So the annual interest deduction, remember your mortgage payment is $550 a month, and we approximated that $450 of that is going toward interest, and when you start out, at least in the first year of payments. So $450 of interest approximately times 12 months, it's not going to be exactly the same every month, but just stick with me here, is an additional $5,400 in interest that you can potentially write off on your taxes. So let's assume you did not own this property. And remember, you make $50,000 a year. Your state tax rate was 25%. Your federal tax rate was 25%. Your state tax rate was 10%. So in total, you're paying 35% in taxes of that $50,000 that you make every year. So you're paying $17,500 in taxes every year. Y'all follow me so far? Thumbs up. Thank you. So now with the rental property, what that tax deduction allows you to do is deduct these amounts from your income before you're charged tax on your income. So now you make $50,000 for tax purposes, minus 3272.73, minus 5,400, which according to my trusty cheat sheet, when you multiply that by the 35% in taxes total that you're paying, now you're only paying $14,464.55. So by buying this property, you've saved an additional $3,035.45. That's, yeah, there's a zero missing. $3,035.45 that you saved in taxes. So you made $3,000 more a year in cash flow from just the tenant paying you more in rent than what you pay on your expenses. And then when you go file your taxes, you've also saved just over $3,000 in your taxes by taking on the challenge and taking on the risk and reward of stepping into owning an income property. Not done yet. I'm gonna erase this one because there's even more to it. I really want everyone to leave here understanding that owning income property is very powerful, just financially for everyone. So another benefit to owning income property, and actually to owning any property, whether it be the property that you live in or income property, this applies to both. Depreciation doesn't, but this applies to both. So principal payoff is, you know, over the 5 years that you own this property, your tenant's monthly rent payments are going to pay down the mortgage for you. So if you make all your payments on time for 5 years, at the end of 5 years, you're going to owe approximately $92,300. Let's say you borrowed $100,000 on your mortgage. You held the property, you kept the tenant in place, you got the $3,000 a year in cash flow, you got the $3,000 a year in tax benefits, and that's assuming you didn't even raise your rent, which you're probably going to do over the years. So even though, so your cash flow is going to grow, even though your mortgage doesn't, if you get a fixed rate mortgage. But on top of that, your tenant who is living in that house has paid your mortgage down to $92,300. That's $7,700 in equity growth or principal pay down that you have earned over those 5 years just for owning the property. That tacks on to the other benefits that we just discussed. Now, the next benefit is appreciation. So remember we were just talking about what the 50-year average is of 5% appreciation over time. I want to be really conservative in this example just to show you how powerful it can be. So I'm almost going to cut that in half. And when we get to the end and you see the numbers, I want you to understand that even if the market were to do what it's done historically for 50 years, you'd be doing almost twice as well as what this example is going to show you. So we are going to only assume 3% annual appreciation. So history has shown over time that real estate appreciates. Appreciation rates vary by location, so check with your local real estate expert for historic rates in your area. Over the last 3 to 5 years in the triangle, there have been a couple years that have had 10 to 11% appreciation in some of the pockets here in the triangle. I know a couple of you guys, especially Minneapolis and in Atlanta, I know for certain, and in Chicago, there are some areas that have increased well there too. So again, we're going to use a very conservative 3%. Also know that there's a potential downturn for that too, because real estate can fluctuate. So you kind of have to take the good with the bad. Expect the best, but be prepared for the worst, just in case. So just know that the historic trend over time has done really well. So if you were to take the value of a $100,000 home and you were to see 3% appreciation the first year, it'd be worth $103,000 the next year. The third year, it's not going to be worth 106,000 because it compounds. So that 103,000, that next year, you're going to get 3% on the initial 100,000 and 3% on that extra 3,000 that you gained in the year before. So it actually accelerates how quickly a property's value goes up in time. So after 5 years of 3% appreciation, your property is now worth $15,927, $115,000. But you have earned $15,000 in appreciation and equity growth just by holding the property over this time frame. You didn't do anything special to it, just by growth in your area. If I had used the 5%, this property would be worth over 130,000, and 5% is the historic norm. This is very conservative at 3% appreciation. So, hang on. So overall, we've talked about a few buckets of, or a few pockets of growth for properties and the reasons why you should own real estate. So overall, over the last 5 years, you have, one, created $3,000 a year in cash flow. You've also created $3,000 a year or slightly above in potential tax write-offs. You've also paid down the mortgage, or your tenant has paid down the mortgage through you by $7,700. You've also grown in value by $15,927. At the total end of 5 years, your benefit for buying this one property is $53,802. So I'm gonna let that sit with you for a second, that you bought a $100,000 property, put a tenant in it to pay the bill for you. Don't want this to fall over. Got a tenant in there to pay the bill for you, maintain the property, did everything else that you need to do in order to be a responsible income property owner. And at the end of it, this is your monetary benefit for a $100,000, for a $100,000 home. So multiply that by if you bought a $200,000 home or a $300,000 home. Just put a multiplier in front of that to multiply the benefit that property is giving you. That's the meaning and the benefit of owning income property. That's what I want everyone here to understand. That's why, you know, I always tell, especially my friends, I'm like, look, I love y'all. I want everyone to own real estate. I'm not going to convince you to own real estate. That's a very personal decision. And again, I will chant risk and reward all day long, but these are true rewards. And this is not that hard, guys. Like it's really, I just want everyone to understand that even owning one property can really change the trajectory of your financial future. And if you can imagine building a portfolio of simple homes, single family homes even. I mean, we haven't even gotten into the conversation of owning multifamily and owning commercial property. We'll get to that eventually. But, you know, we haven't even gotten to that conversation. But this is the power of buying a single family home and hanging on to it for 5 years. If I were to take this appreciation number out 10 years, this would be 6 figures, well over 6 figures, just buying a property and holding it for 10 years at conservative appreciation rates, at conservative rents and other numbers. So if you have any questions about this, now's the time to sort of throw them out there, but are there any questions on the example we walked through? And again, you don't have to write these numbers down at all because they're all online. They're all written out exactly how we discussed them. But what questions do you have? Because I would love for everyone who's on this call, I thank you so much for being here on this call. If I could scream it from rooftops, like just own property, I would. But I wanna make sure that you guys leave with any questions answered. You know, buying property is scary. I still remember the first property I ever bought, and it was scary. And it gets easier over time. You know, it's never just going to be like close your eyes and get it done and don't think about it, because again, it involves risk and you shouldn't, I believe, be that way. But what questions do you guys have so that I can help you to get over the hump if there's anything holding you back from benefits like this? Let's see. What percent of that cash flow do you like to put toward CapEx repairs and vacancies? So my answer to that, some people have a set formula. My answer to that is it depends. So CapEx, everyone, is capital expenditures. That is essentially, that's not repairs. Like if the toilet stops flushing, that's a repair. If something minor happens through wear and tear, that's a repair. CapEx are things like new roof, new heating system, you know, those major or more primary things that help to create a safe, enjoyable space for your tenant. So that depends really on to me, on the condition of the property when you acquire it and on how you prepare that property before you put it on the market. So in the area that we live in here, we have pretty healthy historic preservation tax credits. And I grew up in Chicago on the South Side in a historic district in a historic home, and I love historic homes. So when I started buying rental property here and I found the historic districts, I was drawn to those. And here, back then, for every dollar you spent on renovations, you would get 40 cents back as a tax credit if you did certain things. So for me, I would buy a rental property and I would go in and do full renovations and make sure plumbing, electrical, HVAC, roof, everything, structure was up to par before putting a tenant in. And for me, over the last 10 plus years as an income property owner, that's worked out really well because I haven't had maintenance issues to deal with because pretty much everything's new. However, in my numbers, I would always account for CapEx and repairs and vacancies. So the vacancy number in your area, you can usually get that information from a property manager. Here in the triangle, I remember in some of my spreadsheets, I would have like 8%, which was essentially 1 month's vacancy that I might be assuming. That was, you know, back at the time of this example. Now, in desirable areas here, you don't really have too much vacancy. I have multiple properties that over the last 10 years have not had any vacancy. Just immediate turnover, maybe a day or two just to clean it out. And if you buy in strong areas, you don't have to have that, but you need to always account for CapEx and vacancy in your number. For CapEx and repairs, again, it's going to depend on the property. If you're buying a property that has a 20, 30-year-old heating system and water heater, you're going to have to bump that number up. If you're going in and putting everything new in, you can sort of pull that number down. So the answer to that is it depends. You know, in all cases, if it weren't for the tax credits, I wouldn't have been going in and doing full renovations. So, you know, in a lot of areas, those tax credits are not going to apply. So you're going to want to just have a safe number in there. That number could be 15, 20% for your CapEx and repairs, but you'll have to figure out what the norms are for your area, for your vacancy, and then adjust your repair number for the condition of the property that you're purchasing. I have to say that your income monthly is more important than anything when trying to build your portfolio. Yes, so when you're first starting out, your monthly income is definitely more important because your monthly income is going to dictate whether or not or how easily you'll be able to purchase additional properties. That's another conversation we'll have, and I actually have a YouTube video out there that explains how, you know, have you guys, I know, okay, for me, when I first started, I would see people buy a property and then they go buy another property and then they go buy another property. And I was like, how are they buying all these properties back to back? And I just thought they had gobs of money. And I soon came to realize they did have reserves and have down payments and have access to funds. But the ones even who were getting traditional financing, they were able to qualify for their next mortgage because of the ratio of rents to expenses of the properties they already owned. So having positive cash flow, and we'll walk through that in more detail, having positive cash flow on the properties that you own is very important because unless you have solid reserves, you're going to be, and you should always, always, always have reserves when you buy, even when you buy your first property. Your bank is likely going to require that you have 3 to 6 months of expenses in an account before they will even close your loan for a purchase. But again, the cash flow, the positive cash flow on that property is going to dictate the pace at which you can grow your portfolio. So yes, what Derek said is completely true. So I remember years ago, and this example I probably wrote 7 to 10 years ago. I'd have to look back at the date on the site. But I remember diving into trying to understand this because in my brokerage business, I work a lot with real estate investors. And a lot of my clients I've never even met. Some of them live in New York. I've worked with folks who are buying from overseas. You know, a lot of them are out of state. And I remember having an out of state client who called me from New York and wanted to buy a property. And so I dove into my worksheet, you know, what are your criteria? What are you looking for? What return? I use cash on cash return for smaller properties and cap rate for larger ones. We'll talk about that too. And asked what his return was. And he was like, you know what, Tiffany, I don't need cash flow. And I sat there like, well, so why do you want to buy a property if you don't want cash flow? And he said, I just need the tax write-off. He was trying to get it and close before end of the year for tax write-offs and for some other reasons. And that's when my light bulb went off as to, oh, I need to figure out what these other benefits are that people are buying property for, because if he's trying to buy this much property and doesn't care about cash flow, there have to be some other huge benefits a la that he's buying the property for. That's where all of this came from. So yes, definitely when you're starting out and even throughout, I mean, you don't want to go out and buy a bunch of negative cash flow properties, but there may be reasons why there are properties that you'll pick up that don't have positive cash flow, or there might be situations in your life where you'll purchase property that might not necessarily have positive cash flow. That's going to be on a case-by-case basis. Just have to take that first step. Yes, Marvin, thank you for saying that. So real estate investing when you first start off is scary. I remember the first deal I ever did here in Durham, and I was scared because when you feel like you don't know what you don't know and you're not sure, you know, you don't want to lose your shirt, you don't want to get in over your head, you know. Even I remember signing on the dotted line for it, and I was like, this feels so official. And what if something goes wrong? You know, like all of that stuff that, you know, it's real. And some, you know, unfortunately, some people never get over the hump of that fear. They will convince themselves that they have to read another book or take another class. And all the while, the market is continuing up and they're waiting and they're missing out on this. So at some point, yes, you should be scared. You should be scared, but you shouldn't be scared into not acting. The fear should help you to put a team around you who knows more than you know, who can help guide you through a transaction, who you trust. All of you are in markets where there are brokers and attorneys out there that I'm happy to put you in touch with if you have an interest. Atlanta, Minnesota, and Chicago at least. I think I saw Jersey as well. So, I mean, it's just a matter of surround yourself with people who are experts at what they do. You know, this is a tribe for you guys to get questions answered. You know, in general, these are not going to be state specific questions answered, but just general questions answered. But at some point you do have to just tell yourself, I'm not going to let fear immobilize me from the benefits that can be in my future. I'm going to take that first step and I'm going to be smart about it and surround myself with good people and take that chance because I'm worth it. Are there any pointers on getting approved for the initial loan? Oh, wait, I think I skipped. Just have to take that first step. How do you manage the benefits with partners? So partnering, that's a little bit of a different topic, but how do you manage the benefits? Okay. To keep it simple, it depends on how you partner. If you partner in an LLC, you can divvy out the benefits, even in a way that's not necessarily proportionate to your percentage of ownership of that entity. So check with your attorney with all this. I have to like always give the disclaimer. But like if you are partnering with two other people, you would think that all of you get 33% of the benefit, but if an LLC is a unique entity that allows you to divvy it out however you see fit. One person might get the cash flow, one person might get the tax benefits. I've had folks who've said, Tiff, can I invest with you? I don't even want the cash flow. I just need some tax write-offs. You keep the cash flow. So you can divvy that out depending on how you're partnering with folks. It's just, if you're going to walk into a partnership, and that's probably a whole other topic for us to talk about, because I've partnered on multiple occasions, you just want to make sure that you guys are on the same page, and that your agreement is in writing and that everyone's clear. But again, how to manage the benefits with partners is going to depend on how you structure your partnership. Average annualized rates for vacancy and maintenance. Average. So Ryan, what do you mean by that question? Can you unmute yourself? Are you there? We'll come back to that. Any pointers on getting approved for the initial loan?
You already answered it, Tiff.
Oh, okay.
With the Capex, I just didn't see the Capex question and everything that was up there earlier. So
Awesome, thank you.
Yeah.
Any pointers on getting approved for the initial loan? So when you initially go to a traditional bank, if you are going the traditional route with financing this with a, Freddie Mac mortgage, then you're going to have to qualify for that loan just like you would qualify for a loan on a home that you were buying. They're going to look at your income. They're going to want to see that your income can carry that note. They're going to look at your credit. If there's already a tenant in place and there is a lease that's in place, they may consider the rent that's coming in on that lease. That may vary from lender to lender. So a lot of that is the traditional lending criteria. Just understand that when you get a mortgage, a traditional mortgage on an investment property, from the bank standpoint, that is a riskier loan to give to you. They know that if the stuff hits the fan, you're going to make sure that the bills are paid on the roof that's over your head, your primary residence, before you pay the mortgage on your rental property. So for them, that is a riskier mortgage. So they, one, will typically have a higher interest rate on that mortgage, and two, will typically require a higher down payment for that mortgage. There are a lot of resources out there now where you can get into a home to live in with little to no down payment. There are a lot of even 100% programs out there for a primary residence that you're going to live in. There are not 100% loan programs for an investment property that you're going to rent out. Typically for single family, the minimum down payment is going to be 15% for a traditional mortgage. Duplex will probably be 20%, triplex quad might be 25%. So you're going to have to put more down because the bank is viewing that as riskier. So they're going to just want to see more equity from the start when you buy that. So just keep that in mind for traditional financing. There are a lot of creative ways to finance. I know a couple calls ago, my partner Craig was talking to you guys about seller financing and some properties that he has on seller finance deals. So there are a lot of ways to finance properties that are not the traditional route, but for the bank route, credit, income, and reserves, a lot of banks are going to require that you have sometimes 3, sometimes 6 months of reserves in an account. It doesn't have to be like sitting in your checking account. It can be in a retirement account. It can be, something in an investment account. But they want to see that you have reserves in place in case things go wrong. Where to find homes that are not listed? I have renters ready to move in. I just need homes that are actually affordable or maybe need a little work. So there's no one answer for that, Jamie. You can find properties through wholesalers. You can find properties from driving and just paying attention. You can, paying attention if you're looking for fixers, where you might be able to get them a little below market and fix them up and then put tenants in. You can get them from driving neighborhoods and just noticing, hey, that property might not be as well kept as the others around here. Maybe the owner has financial situations going on. Maybe they would be interested in a sale. You can send letters. You can, I get irritated nowadays because since our market is so hot and the do not call list was chucked, people are calling and texting now trying to buy properties. So I'm sure some of you are getting a lot of letters and postcards and even phone calls and texts now. So, I mean, there are a lot of ways to find them. You can go down to the county courthouse and see who's buying properties at the auctions, and what properties are available to buy at the auctions. FYI, if you go to the auctions at the beginning of the year, it's going to be way more crowded typically than toward the end of the year, because everyone has a New Year's resolution they're going to invest in real estate. So everyone is at the foreclosure auctions at the beginning of the year. I've just noticed that as a recurring trend. It's kind of like the gym. Everyone's at the gym at the beginning of the year because of that similar New Year's resolution. But did you say tax deductions on rental properties only? No. There are tax deductions for owning income property as well, and depending on your tax situation, like interest, write-offs, et cetera. You just don't get the depreciation write-off, that extra $3,035 depreciation write-off. Oh, sorry, and I left one off of here. There was $5,400, because clearly this math doesn't add up. There was 54, I'm not left-handed, but I am right now. I can make it 5. There's $5,400 from that last example. That was the interest write-off, that $450 a month interest. Hang on a second. It's gonna bug me if this is incomplete, even though right now it's kind of a moot point. Yeah. So all of that adds up to $53,800. But yeah, there are tax benefits to owning a primary residence. So for those who have zero interest in owning income property, at least consider owning a primary residence, because you still get that principal pay down. It's just that you are paying the principal down. When you own a home, when you rent a home, you're paying rent every month. When you own a home, you're paying mortgage every month, but you're kind of paying yourself, because part of that pays your mortgage down, so that you end up with that, in this example, $7,700 in principal that's paid down off of that $100,000 over time. So you pay yourself when you own a home out of that monthly payment. Also, when you own a home, you get the appreciation. If it goes up at 3% a year, you're still going to get this benefit. In some cases, you'll get an interest write-off, but tax law recently changed, so you may or may not benefit from that. You're not going to get the cash flow. You're not going to get the depreciation. But owning a property, period, gets you the bulk of these benefits. So again, whether you're looking to be an investor or not, at least strive to consider owning your own home. Let's see. You said 100,000 is unlikely in the Triangle area. So what are the average sale prices now? And if you're looking at 20% down, would you recommend saving first? The down payment seems like it could be overwhelming if you don't have cash flow yet. So yes, at this time, years ago, you could easily get a property for $100,000. The first home that I ever lived in, I bought for under $100,000. I got it on a short sale, but even the market value was probably right at 90 something or just under $100,000. I think I got it for like 70 something on a short sale. So back then, these numbers were realistic. You can still buy properties now for $100,000 or just above, but they're going to be in need of more repair, or might have other deficits that you'll have to overcome during the time of your ownership. The average sales price in the Triangle now is over $250,000. So it's changed a lot over the last 10 years. That's for a single family home. I can pull the exact numbers up, because before, Durham and Raleigh are pretty much neck and neck right now, but both of them are, I think they're closer to about 260, 270 as the median price right now. So if you're going to go about it the traditional route and buy a home or a duplex, et cetera, and go the traditional bank route, then yeah, I recommend, setting aside and saving funds, et cetera. Know that there are other ways out there to buy property. We can talk about that again in future conversations, but there's nothing wrong with the traditional way. I've bought plenty of property that way. And the nice thing about traditional loans is if it's something that you're going to own long-term and you're not able to get a little bit more creative on the purchase and you have to go in with a bank loan, that mortgage is going to be set for the next 30 years, but your rent is going to go up every year for the next 30 years. So you get that comfort of stability for a 30-year mortgage, unless you opt for a shorter term mortgage, which again, of course, I'm always going to interject my opinion. I know a lot of folks consider 15 and 10-year mortgages because the interest rate might be about half a point less. I think what we're going through now is probably a good example for folks to consider being conservative in your monthly outlay, and being conservative in the amounts and in the payments that you lock yourself into for the long term. So I always recommend to folks, unless there is a huge difference in the rates, which I've never seen, or unless you're buying a much more expensive property at our median price here, you know, $200,000, $400,000 for a single family or a duplex or a quad, the payment isn't going to be that different to give away the comfort. And I would recommend locking yourself into a traditional mortgage if you're getting traditional financing, but you can elect when you want to make the payment for the 15-year mortgage. When you're cash flow heavy and you have extra cash sitting around, you may as well pay it into the property and pay that debt down. But you're only required to make the lower 30-year payment. That's always what I recommend, unless the interest rates, again, are really drastically different, or there might be other factors that play into your situation. So yes, to the question, I recommend saving if you're going the traditional financing route, which is a solid route to go. But yeah, the down payment can be overwhelming if you don't have the cash flow yet. That's why, you know, creative financing and other methods are always good to research. You know, if you Google creative real estate financing, you'll find a lot of information on that topic. Majority of folks who dive into real estate, though, do dive in with traditional financing. So I've heard of investors speak about the 70 rule. What's that, and what's the value in knowing that? So that's a different topic. That's rehabbing. The 70% rule dictates the price at which you should offer to buy a property. So we're not going to dive into that here. It goes, let's say when you are looking at a property and you know that after all of the repairs on the property are done, let's say it needs $10,000 in repair, and after you make $10,000 in repair, it's going to be worth $100,000. The 70% rule says that your offer on that property should be 70% of that $100,000, which is $70,000. And then you subtract out the repairs of $10,000, which brings your offer down to $60,000. And then if you're going to flip that property, then you subtract out the profit you're expecting from that 60, whatever that is, another $10,000. And that 50 is what you can offer on the property. So that's the 70% rule. Some people, you can apply that to rentals as well and not buy over that amount. But really, when you look at income property, you're going to be looking at the cash flow off that property as opposed to the percentage of value of the property walking into it. How do you avoid capital gains if you sell a property? A couple ways. The primary way, check with your CPA and tax accountant, but a 1031 exchange is a great way to defer as opposed to avoid capital gains when you are selling a property. So typically when you sell a property, let's say you're going to sell this property and you stand to make a gain, which is not the same as your profit. But let's say you stand to make a gain of $20,000. That counts as income and is a capital gain. And depending on how long you've owned the property will determine whether it's short-term or long-term and how much you'll owe on taxes because of that. So if you, let's say, are in the 25% tax bracket and it's a long-term capital gain, so you're taxed at your tax bracket and it's 25%, and you're going to make a $20,000 profit, 25% of that, or $5,000, would have to be paid in taxes. You can avoid that by doing a 1031 exchange and rolling those proceeds into another property. And the nice thing about that is that now, instead of making $25,000 in a gain on this property and having to pay $5,000 in taxes and only have $20,000 left to play with and invest with, now you can roll that full $25,000 over into another property. That could be your down payment for the next property, and you might not even have to put a down payment on that property. And now you've temporarily avoided having to pay taxes because you rolled your gain into the next property. So that's what a lot of folks consider. I was actually talking to a client yesterday, Michael, who had bought some property with me about 4 years ago, and he's thinking about selling one of them. And he has, because our market has grown a lot, has about a six-figure gain that he's going to realize. And he was trying to figure out, do I want to just pull this out, or do I want to roll it into another property? And so just had this 1031 conversation with him recently. So definitely look at 1031 exchanges. There are a couple other ways to defer your gain, but that's the one we'll discuss today. That's the most straightforward response. Challenges to overcome funding opportunities for the first-time investment property. How to find off-market multiple families, how to determine value in high market area, and how to find a reasonable deal. So funding opportunities, I'm not sure what that is. I don't know if you mean like creative financing or other items, but how to find off-market multiple family properties. That's either pulling up your local zoning map and figuring out where the zoning is for multifamilies in your area, which actually if the zoning came before the property was built, there still might be properties outside the zoning area that are multifamily, but a lot of it is, you know, driving your area, getting familiar with your area. But finding off-market multiple family properties, a good way is to, you know, get to know your local property managers, because they probably manage some of these properties and they know when their clients are interested in selling them. How to determine value in high market areas and how to find a reasonable deal. So if you have a real estate license, it's really easy to determine value. That's actually why I got my license, not necessarily in the beginning to be a realtor, but to help with my investing activities. And I wanted access to this dearth of information that I thought realtors had access to, the MLS. If you are not, the good thing is now, as opposed to back then, there are a lot of resources. Some of them are subscriptions that you can purchase that give you pretty much the same, if not better info than the MLS has. Your local tax office, your real estate property tax office, has information on every property in your area. If they have a good website, then you can find out values on properties from your municipality's real estate or tax website. Some people look at Zillow and some of the other sites. Yeah, so some of those sites are accurate in their market analyses and valuations of properties. Some of them are a little bit off the mark. So when you get your information from there, just take it with a grain of salt. And if you have a way to sort of go behind and double check those numbers, definitely do that. How do real estate agents feel about working with investors who may be buying homes under 100,000, since that might not be a great return for them? I will say, I've had this conversation a lot with my colleagues. I will say that depends. That depends on the agent, and that also depends on you. If you're buying $100,000 properties and you are specific in what you're looking for, and you're looking at it as an investment, so you're not getting caught up in the aesthetics and all the other fluff that matters but doesn't, and you are a decisive person, then a real estate agent shouldn't have an issue in working with you, because you're not going to drain their time for a smaller return. If you are not that, then it might be more difficult for you to find an agent who wants to work with you, because they'll understand that it's going to be very taxing, and they're taking there are only so many hours in a day. So brokers have to decide where to place their efforts. So, again, that depends on the agent, that depends on you. But there are agents who will work with all types of investors. So don't feel like you can't approach an agent to work with you because of the dollar amount. Just understand that you may need to help balance that out so that it's a fair return for both of you. What local literature in Durham can I read to determine what type of residential properties are in highest demand? Examples would include number of bedrooms, single family, duplex, or triplex. That's where, you can read local literature. I'm trying to think about, I don't know if there's a document, and if anybody knows of a document, please put it in the chat room. I don't know if there's a document or a resource for that info. I lean to property managers for that info. So that's something that I would call Germany or Chris or, property managers who are experts in that area, because they're working with tenants every day. That's what they do. They manage properties. They put tenants in the properties. They know what tenants are looking for. They know what's more desirable. So property managers can be a really good resource. I remember years ago, I had clients who they were from California and they wanted newer construction. They didn't want existing property because they were concerned about the maintenance. So they asked me, hey, Tiffany, can we change our search, and instead of you helping us find an income property, can you build like some small multifamilies for us? And I said, sure. And I called one of my property managers, actually the one who's going to be on the call in 2 weeks with all of us, who I'm excited for you to meet. And she said, Tiffany, 4-bedroom units are in high demand, because in our area, we did not have a lot of 4-bedroom properties that were in good condition. And this was soon after the recession. So a lot of people had started coming home, and like you might have had one family living there, but then the daughter or the son or their family might have moved in, so they needed more space. So 4-bedroom properties were in really high demand, but they wanted 4-bedroom properties in good areas. So that's what we built for them, and they did fabulously. So your property manager would be the best resource, or your property managers would be the best resource to tell you what's in demand. And they would be happy to tell you that, so that you can let them know when you find that, because they're probably coming across a lot of tenants and they might not have enough property to put those tenants in. Explain again the benefit of putting existing rentals in an LLC and securing commercial lending to avoid showing up on personal credit, as it is applicable when securing new financing. Okay, so the short of it is, we talked about this at a recent face-to-face wine and real estate before all this happened. And you can buy properties in different ways. Let's say you want to use traditional 30-year bank financing to purchase your income properties. You can do that. Most banks, all banks, have a limit of the number of properties that you can purchase with mortgage financing. Now, unless it's changed, the federal limit, it used to be 10, and it might still be that way. But even though the federal limit is 10, most banks have a limit that's far below that. I've seen some banks have a 4-property limit, meaning they will only hold 4 mortgages for you. Like you can have either 4 income property, you can have a single family home and an income property, but they will only hold 4 for you. Some I've seen 6. I don't think I've seen over 6, but they might be out there. So let's say you get to a point where you have 6 mortgages and you can't find a bank to give you another loan. And they're mortgages that you've had for at least, a few years, 5 years, they've gone up in value, you have some equity, you've had benefit. In those cases, it might be worth, now remember, all 6 of these properties are on your personal credit report because you got mortgages for them. So they're showing up on your personal credit report. When you get stifled and you can't buy anymore with that type of financing, and if you want to clear it off of your credit report, you can go to a bank and ask for a commercial loan or a blanket loan. You might be able to put an individual loan on each property or put a blanket loan across all of them, with some caveats that are important to consider, release clauses, etc. But that moves them into an entity with a commercial loan, because your entity has a tax ID number and it exists as another sort of non-breathing human over here to the side. And that takes all those properties off of your credit report. So now you're in the clear and you can go buy again. You still have to tell the bank that you own these properties in this entity, but since they don't exist on your personal credit, you meet the criteria of the bank, and you can potentially, depending on the situation with the properties and your finances and everything else, go in and get more financing and start to build again, move those over, build again, if that's the route that you want to take. Can you speak to the process of turning a primary residence into a rental investment property? Move out and put a tenant in. That's pretty much the process. If you buy a home with a traditional loan to live in, and then life takes a turn, there's no set time frame. If life takes a turn and you have to move out and put a tenant in, that's what you do. What you do not ever want to do is say that you're buying a property to live in it, knowing that your intention is to rent it out, because that's loan fraud, people. So you don't want to do that. But if you live in there and later on decide that you have to move for work or move for other reason, and you don't want to sell the property, you want to make it a rental, it's really just as simple as moving out, advertising the property, putting a tenant in place, getting a lease in place, etc. You want to make sure, and I'm not aware of any loans that, oh, yes, there are. So if you bought the home, like here in our area, there is a city second program that offers down payment assistance for you. Some of the city second programs require that you be a resident of the home for the duration of that loan. So if you move out and want to put a tenant in place, you have to either refinance the property or pay off that second mortgage that covered your down payment when you first moved in. So you want to make sure whatever underlying financing that you have on that primary residence does not disallow you being able to rent it out. Let's see. Do you recommend using your own cash or financing for investment properties? Both. And it depends on the property. There are going to be cases where you can creatively finance the purchase. There are going to be cases where you can get a loan on it. And as you build your cash reserves, there are going to be cases where it might make the most sense to go in and pay cash and put financing behind it and put your cash back in pocket because of that, if you're competing for it. So, I mean, all of the above. There's no silver bullet. There's no one way to do things. The beauty of real estate is that you can create your own niche and you can fall into the place where you're comfortable and you can live in that place for your entire investing career. Or similar to me, I started out in one space, which was wholesaling, and then transferred that into rehabbing and new construction and development. And then alongside that had the general contracting and brokerage, you know, realtor TIF. So you can do what you want to do when it comes to investing in real estate, and you can do the types of deals that you want to do. Just pick a place to get started and become an expert at that. And if you do want to switch gears, you know, definitely switch gears, but don't take the shotgun approach trying to do everything and be everything to everyone, because that lack of focus can sort of leave you a little scattered such that you really don't get anything done. Do renters pay all utilities? Do you make them put it all in their names? It depends. I personally have done both. I have rented, you know, properties where the tenant moves in and all utilities are in their name. I've rented properties over by Duke where I cover the utilities and they sort of are renting a space in that home. So it depends on the property. It depends on the property and what makes the most space. In the case where I was renting it out by the room to Duke grad students, it was because the rent per room was way higher than what I could have gotten if I would have rented that home as a unit. So it made more sense to do it that route and increase my cash flow. In some neighborhoods, it might make more sense for you to just rent it to a family, you know, or rent it to a tenant on a traditional 12-month lease and go from there. Can you explain the benefit of FHA financing, i.e. 3.5% down, financing up to a fourplex with the ability to house hack? Yes. So for those of you on the phone or on the call who are interested in buying an investment property, understand that if you buy an investment property that is more than one unit, if you can get an FHA loan for 3.5% down to buy a home if you want to move in. There are also programs where you can buy a home with no money down. Pinnacle has a good program here. State Employees Credit Union has a good program here. There's still some down payment assistant programs here that can cover your down payment for you. So you could potentially get into a home with no money down. But let's say you're doing an FHA loan, 3.5% down. You can buy a single family home. But lo and behold, you can also buy a duplex, which is a 2-unit. You can also buy a 3-unit, which is a triplex. You can also buy a 4-unit, which is a quadruplex. So imagine that you can, with 3.5% down, and repeat that. So imagine if you can buy a 4-unit building and live in 1 unit and have the other 3 units cover the mortgage and potentially put some cash in your pocket. The term for that is house hacking. It's sort of finding a way to make your home make money for you. Some other ways people house hack is buying a home and renting out a room. I have a friend who's been doing that for years. She was renting for a while, and her college roommate, after they graduated from college, was still her roommate because they're best friends. And then when I helped her buy a home a couple years ago, that same roommate came and moved in with her and is helping her pay down that mortgage and create that principal payoff that she has, in addition to the fact that that tenant is paying off part of her mortgage. So house hacking can be a really fun way to get into real estate if you haven't bought a primary residence and you're trying to figure out a way to get into property and make it make money for you. You might have already covered this question. To maximize income, can a large lot, half of an acre or larger, be rezoned to multiple lots in an RU5 district? If so, what is approximately the length of time and difficulty of getting the rezoning approved? So that isn't a rental question, like income property question, sort of cash flow. So I can help you with that offline. So who is that? Oh, James. Yeah, I can help you with that offline. Just send me a message and we can follow up on that one. Aaron, hey. Oh, he answered it. Okay, thank you. Hopefully you saw that, James, but Aaron answered it right below you. Ashanti Nicole, I'm not sure if I missed this, or how are people buying without a job? If you own a house, how long do you wait to buy something else, and can you use money in the home to do so? So number one, how are people buying without a job? If you're using traditional financing, you're not. If you're using creative financing, which might be finding a seller who has a ton of equity and he'll finance it for you, using private lenders, other means to creatively finance your deals, then you can buy all day, forever, for the rest of your life. If you're going to a bank for financing, they're going to check to make sure that you're employed at the start of your loan process, and they are going to check to make sure you're still employed right before you close. So people be aware that if you go under contract right before you close, they're going to do an employment check to make sure you're still employed. And they're going to check your credit again right before you close to make sure nothing's changed in your credit situation. So don't go under contract and go buy some stuff or open any accounts or buy appliances or buy materials for repairing the place that you're going to close on. Don't buy anything until the day after you close. If you own a house, how long do you wait to buy something else? That depends on you. That depends on your comfort. There's no right or wrong answer for that. You could buy a house and buy an investment property right behind it if the financial situation and the market and the property all line up and it makes sense for you. Can you use the money in the home to do so? Absolutely. So that's $7,700 in principal pay down, along with that $15,927 of equity. So approximately $23,000 in growth over that 5 years. That's equity in your property. That's value that you've created in your property. So your property is worth $115,000. You've paid it down to approximately $92,000. You have value in your property. And if that's your primary residence, you can tap into it a couple different ways. One, you could potentially refinance and pull all the cash out and decide what to do with the cash. There are pros and cons to each of these. There's no single right answer. But if you refinance, so Tiff's belief is refinance if the interest rates are such that there will be a benefit to you. Like if you are paying $1,000 a month for your mortgage and you have a 6% mortgage from way back when, and now rates are at 3%, and you can refinance and you can potentially pull some of the equity out and lower your payment, or some combination that makes sense to you, then definitely do that. Don't be one of those people that refinances every year because the rate changes a quarter point, because you're giving away, that refinance isn't free. You're not writing a check for the closing, but your lender is charging their fees to the equity in your property. So every refinance you do, you lose a bit of equity potentially. So don't go refinancing willy-nilly unless there's a meaningful reason for it, but you can refinance and pull money out of your property. I am a fan of home equity lines of credit. There are banks who will give you 90% of the value of your home. So let's say your home is worth $100,000 and you owe $50,000. You have $50,000 in equity. The 100,000 minus the 50 that you owe. You can go to a bank right now, and most banks will give you 90% of the value of your home minus what you owe on your home as a checkbook and a credit card against your home, which is an equity line. So in this example, it's your house is worth 100,000. They'll give you up to 90%, which is 90,000 minus the 50,000 that you owe on your mortgage. So that leaves 90 minus 50, which is $40,000 They'll hand you a credit card, they'll hand you a checkbook, have a nice day, and you set it aside for a rainy day or for an investment or for something else that you might need to use it for. If you never use it, the beauty of it is you're never going to pay interest on it. It's kind of like having a credit card that is secured by your house. Once you use your credit card, you have to start paying it down. And eventually when you pay it off, it opens up the full line and you can use it again and again and again. Same thing with a home equity line of credit. It's sort of like having a line of credit against, or a credit card against your house. So you need to make sure that you use it very responsibly, because that money is not a gift. You will have to pay it back when you use it, since it's secured by your home. So it's not something that you want to be risky with, but it could be something that allows you to go out there and make a cash purchase and then go to a bank and pull the cash back out. You know, it could be something that allows you to make some repairs short term, or use for other means. So home equity line of credit or refinance. And there are some other ways, but those are the first two that come to mind. You mentioned a couple options for zero down payment programs. How do you research other options? Google, talk to your local realtors, talk to your local lenders, mortgage lenders. Those are some of the best ways to find different loan programs. Realtors are going to be working with different types of buyers that use different loan programs all the time. Mortgage lenders do different types of loans all the time. You can go to your bank and see what they have to offer. If you bank at one of the big banks, you probably want to go and check at another lending institution as well to see what they have in addition to the standard programs that the big banks might have. But yeah, those are three sources for you to check. If you have a line of credit on your primary, can you get another on a rental property? You used to be able to do that. I remember when you could get up to 90% of a line of credit on your primary and an 80% line of credit on a rental property. After the recession and since the recession, I have not seen any 80% programs. If anyone out there has seen any home equity line of credit programs or home equity loan programs for investment property, please note it in the chat, just to share with everyone. I haven't seen them recently. They may come back, may not. But again, a loan on an income property is riskier for the bank. So of course, since that equity line is on top of that loan, that's even more risky for the bank. So it makes sense why they sort of got rid of those after the market got a little funny a decade or so ago. I think we covered them all. Are there any other questions? I'm kind of excited that y'all had some really smart questions in here. I mean, all of them hopefully helped everyone. And again, thank y'all for coming out and talking real estate. Next week, we are going to have one of my favorite property managers on the line. So I'm telling you right now, start your bullet point list of all the questions that you want to ask the property manager. She's excited to meet all of you and to share what she knows. I've been working with her for probably almost more than 7 years. I wanted to say 10, but I'm not sure if it's that long. I'll figure that out before next week, but she's amazing. So she's going to take the lead on that and share what she knows with you. And hopefully this has encouraged you all. Hopefully, in my Vanna White voice, this has encouraged you all to understand what the benefits are to owning income property, because I want everyone to benefit from that if that's what's in your heart. And consider me a resource if I can help you in any way. I am happy to do so. And yeah, have a great weekend, guys. I'll see you next week. Thanks.
Thanks, Tiff. Thank you.